Reventure Consulting just came out with a new video today, Nick Dorley. How the Fed destroyed the housing market. I'm a real estate investor. I'm going to be reacting to this video. I find it useful to watch this together. I like watching videos with people, reaction videos, hear their thoughts and insights on it. So I'm going to try to do that here with you. Let's dive in. I don't want to talk too much longer. I hope you enjoy watching the video with me.
We need to talk about how the Federal Reserve of America has destroyed the housing market, making it impossible for the regular American to afford a home. Because even though home prices have started to come down over the last year, they are still at nearly the highest level of all time, even higher than they were at the peak of the previous bubble in 2006. And to understand how we got to this point where prices...
So that has to do with the Housing Affordability Index, meaning how much a house costs for a monthly payment compared to how much someone earns per month. That's what that chart really showed. So it's showing that the houses are still literally as unaffordable as they have ever been. Still.
So high. All you need to do is look at interest rates. And in particular, you have to go back 20 years to post 9/11, post dot-com bust America, because that's when Alan Greenspan, the head of the Federal Reserve in the early 2000s, did a historic interest rate cut that changed everything in the housing market and economy forever. And it occurred right after 2000 when the short-term federal funds rate was 6%. Greenspan cut that Fed funds rate down to 1% in 2003. And basically since then, the Fed funds rate only averaged 1.3%.
So here's what happened. An immense amount of money went into the stock market, the dot-coms of the world, literally. And money had to leave that because all those evaluations were insane and those companies didn't make any money. But the money, the capital, the investment money had to find somewhere to go. With the interest rates going down like crazy, it made tons of sense to start pushing money into the real estate market, a la leading the next 7-8 years into the great financial crisis.
And that long-run interest rate suppression.
It's important to realize that capital, that money always finds somewhere to go. It always finds where it can get the best return. Okay, think about that. And money can only sit one place for so long or be flowing in one direction for so long until it becomes oversaturated and not the best place and it flows somewhere else. That's something to think about, at least after this video. That's very, very important to know that about economics, to know that about investing.
Is what caused home prices to become unmoored and to become detached from the fundamentals. And when I say fundamentals, what I'm talking to you about as a home buyer are income and wages, where something started happening in the early 2000s where the home prices, the yellow line, they started growing much faster.
I told you what happened. The money, all that money in the dot-com bubble that flushed out of the stock market went directly into the housing market because Greenspan lowered interest rates to super low, like 1%. And of course, banks make money by lending money. So they had all this capital. They're like, what do we do with it? We'll put it into real estate and give mortgages. And those mortgages got riskier and riskier and riskier because they were making so much money.
Than the blue line, which was income and wages. And we had that big bubble in the mid-2000s in 2006, and then prices crashed. Now then we had another big bubble that peaked in 2002. Prices are starting to come down. They're still way too high. But really what I want to point you to, folks, is here, the blue line. Income growth over the last 50 years in inflation-adjusted terms has only been 24%, meaning home prices have grown about 4 times faster than the rate of income growth. And that's why it feels so expensive to buy a house. Prices went up for so long, faster than your incomes, that you look at a house and you're like, I can't afford this, right? And it's a situation that was not the case historically. If you go back 100 years on the US housing market, prices never really went up above income, which makes sense because ultimately it's your income as a home buyer which dictates your ability to afford the down payment and mortgage payments, unless the Federal Reserve steps in and starts manipulating interest rates, like in the last 20 years. If the Fed suppresses interest rates, all of a sudden that plows more people into the housing market. It makes investors want to buy homes. It makes certain home buyers more able to afford homes in the short term when the mortgage rates go down, which can cause the prices to go up. And that's exactly what has occurred. Greenspan rate cut in 2000, right? And it was right after that rate cut where the home price growth.
No doubt. Because money goes to where it can appreciate the most.
And crazy. And then the rates maybe went up for a year or two, but basically stayed close to 1% for the next 20 years. And that is what is...
Let me move my face.
Allowed prices to grow. Now, what do you notice? Rates have been going up and prices have started to go down. But here's the frustration.
Wait. Let's see that again. Look at this. Look at this. Notice here with this chart. See, it's going up, up, up. And if we follow that all the way up, that would bring us to pretty much the peak. And then it goes over a little bit and you start to see a dip correlated with that dot. And then this dot right here goes with that one goes with that one, and then it's just flat. And it finally bottoms out because interest rates can't go any lower and prices finally find a bottom. I'm guessing this is probably about 2012. And then start going up, and then interest rates start going up too. That causes a little jink in the armor here, but look how fast that goes up. But then they cut interest rates again because the Fed did what they did by lowering interest rates like crazy, because they started to try to raise them, but then it was something called the taper tantrum that the markets put on. The stock markets went whoop. I wish he had that on here, the S&P 500. Then it went down and said, all right, let's back to the moon. And then we had the Rona dump and off to the moon from there. And then this would be, I'm assuming this would be about May of 2022. Let's get back to it.
Notice rates have been going up and price.
But that's what I wanted to show is that this right here going here, right? And then that dip, look at this first little dip right here. Not that I'm saying we're going to have a great financial crisis, but that is something worth looking at, right? You see that going up. And if these rates do end up getting cut, if the Fed does end up cutting interest rates, well, it's not going to be because they're nice and they want you to feel good. It's because the economy, the macro environment is on fire. And they got to cut interest rates to try to put it out. And I don't just mean inflation. I mean way worse than that.
Have started to go down. But here's the frustrating thing about today's housing market is that we're coming out of 20 years of interest rate suppression where all the participants in the housing market, whether they be buyers or sellers or investors, they became conditioned to expect the Fed to just bail them out whenever things got tough or difficult. And so right now there's this idea in the housing market that that's still going to happen again. And a lot of people are thinking one of two things. Number one is that Jerome Powell is going to pivot and cut rates and make it easy for them to buy a house or to continue their investment program. But more importantly, number two is that due to all the Fed rate cuts and the Fed stimulus, people actually don't think a recession is going to be that bad. And I honestly think that's the biggest reason why we're not seeing inventory grow as fast as we want on the US housing market. And it's why new seller listings, according to data from Redfin, are down 21% year over year. Sellers don't want to list their homes right now, which is an unfortunate development. It's not one that I expected. I thought these sellers wouldn't be as stubborn. I thought they would look at the fundamentals and say, hey, it's time to get out of the market. But they're not doing that, and they're likely going to have to be forced to do it through some type of either major job loss, some type of liquidity event, because they have been conditioned by 20 years of low rates and Fed bailouts to expect that that's not going to happen. And one way that you can really clearly understand what's going on right now in the housing market is by looking at D.R. Horton, the largest home builder in America. Here's the crazy thing that D.R. Horton is doing. They're offering their home buyers special interest rates, a 5.25% fixed rate FHA mortgage, when the 30-year fixed mortgage in America is trading at 6.6%. And the way they're accomplishing that is by doing expensive mortgage rate buydowns, which is now negatively impacting their profits, with their net income crashing by 35% year over year in the most recent quarter due to their higher cost of sales from these buy downs. And so I just want you guys to think about actually how crazy this is. Like, the Fed's intention with higher interest rates and higher mortgage rates is to suppress activity in the housing market, in the economy more generally. But what D.R. Horton and other real estate investors are doing is they're just ignoring that, and they're actually doing the opposite. Like, they're accepting lower profits to keep the sales velocity going, to keep the top line revenue looking good, which is the opposite of what they should be doing in a rate hike environment in the beginning of a recession. But they're doing it.
Well, I mean, what would you do? Picture being the biggest home builder in America, and you need to keep your sales and profits going. Your sales especially, you need to keep that cash velocity going, or else your stock shares and your investors plummet, and your stock and your board members, your investors, your main shareholders lose their shit, because that's what our economy is built on, is constant growth, doing better this year than last year, and they're doing their best. But I don't know how much more energy they got to keep running through that quicksand.
They're saying, look, we'll take the hit in the short term, keep the business going, and eventually, the Fed's going to cut interest rates and the economy's not going to get hit that hard.
But if they cut interest rates, what did I say? It's because it's a terrible environment and the Rome is burning, right? And we may have 7% unemployment by then. That's going to have a dramatic effect on the housing market. He's probably going to say that. I'll stop.
Then business will be as usual. But the problem that I'm starting to see is that the Fed is looking less and less likely to pivot and cut interest rates. And in fact, if you go to the betting markets on where the Fed funds rate is going to be by the end of the year, they're projecting that at the December 13th meeting, the last one of 2023, they're projecting a 4.5 to 4.75% Fed funds rate, which is only 25 basis points lower than today. And so if the betting markets are right, and the Fed only basically cuts rates by 25 basis points between now and the end of the year, that's going to mean mortgage rates are still going to be above 6%. And that means that a lot of the builders like D.R. Horton,
they'll be way above 6%. They'll be higher than they are right now because it's a riskier environment for banks and mortgage companies to lend into.
Investors that I know that are kind of accepting lower profits and lower returns to keep the train moving, well, they're going to start to have problems. Because at some point, the people who are giving money to all these investors and builders, their shareholders, are going to start asking and demanding for higher return. They're going to start saying, wait a minute, why are you guys getting a lower return than I can get investing in a U.S. Treasury or buying a certificate of deposit? Give me my money back. And when that capitulation occurs is when you're going to see what I would call the real sell-off out of the U.S. housing market, where you see a lot of investors start to actually really sell their houses, start to discount their houses, especially as the recession gets worse, everyone. And by recession getting worse, I want to be clear what I mean. I don't mean more layoff announcements. I don't mean the stock market going down. I mean specifically the unemployment rate going up, which is operating right now at near a record low, 3.5%. We're going to have to see this.
Look at that chart. This goes back to 90. I was looking at it the other day, going back to the 50s. It's crazy how when unemployment gets that low, it just ends up taking off, right? Down here, what happened? Boom. Down here, boom. And this is really the level to watch, is right here. And we are way below that. When you get under 4% unemployment, that's extremely low. And that can only kind of sustain for so long, as odd as that may sound.
Unemployment rate go up to create the type of...
And it usually happens, obviously, right before a recession. Today, quick side note, but very relevant. Be sure to hit the subscribe button, by the way. My basically sister-in-law is a nanny, and she is a nanny for a couple that work in tech. Right, I live in the Pacific Northwest. Lots of tech here, Amazon, Microsoft, etc. The guy, the father of the child she nannies for, just got laid off today at Meta, right? I think they've done God knows how many layoffs so far. I think the mother might work at Meta, Facebook also. And I'm like, oh, because that's the first time that someone even within a few degrees of me has succumbed to these layoffs, even though I live here. And I take that as something. I take that as relevant, like, oh, it found its way into my sphere. That's interesting. Drop a comment below if you know someone, or maybe you, that is involved in the tech layoffs or any layoffs. Let me know what is going on in your neck of the woods.
Forced selling situations that really push prices down. And
like he's saying, when unemployment goes up, people will just have to sell even though they don't want to. Now, the question is, how much will that affect the markets? It would raise inventory and it would lower the prices.
Really going to need to see it, go from this blue shaded area more to this orange shaded area that you see that corresponds more with recessions. And just to give some history, folks, I like to go back to 2006, 2007, the last housing crash, kind of the beginning of this last crash. You can see the unemployment rate was low, at a record low in April 07. Then it started really going up by the end of 07. Then in 08, the unemployment rate exploded and reached a peak of 10% in 2009, which is really what fundamentally pushed home price.
And the stock market bottomed in March of 2009. Unemployment peaked in October of 2009. So that's something to remember. The market typically bottoms roughly 6 to 9, maybe 12 months, usually 6 to 9 months before the unemployment peaks and earnings bottom and the recession really kind of ends.
Is down a lot in that
Something to
last
remember.
crash. And there's actually a very defined timeline of events that occurred in that last housing crash. In 2006, home sales collapsed. In 2007, prices started to dip. In 2008, prices collapsed as unemployment rates surged. And then foreclosures surged in 2009 and 2010. And that timeline is important to understand because a lot of people have it backwards. They think the foreclosures increased first. They think foreclosures caused that last housing downturn, but no, the foreclosures were something that simply piled on and made it worse. And you can see that very clearly on this graph. The green line shows the month-over-month change in the Case-Shiller Home Price Index. It started going negative in 2006 by a little bit, and then a little more in 2007, and then it was late 07, early 08, where we started to see bigger price decline in late 2008. Now, compare this to the amount of foreclosures. The foreclosure inventory as a percentage of total mortgages. Note that this was actually fairly low through 2007, right? 1.4%. It started to go up then in late 2007 to 2%, which was still a level that was fairly reasonable. It really wasn't until 2010 where the foreclosures really peaked at 4.6% of all mortgages. Coincidentally, 2010 into 2011 is actually when we started to see some recovery in home prices in America.
Double dip.
And so those foreclosures are a lagging
and that was the
indicator.
actual
And right now in America, the foreclosure rate is pretty low in 2023 overall. Now, the mortgage defaults are starting to go up, especially for FHA, low income, low credit borrowers. But it's going to take some time for those increased mortgage defaults to percolate through the system and result in big increases in foreclosure inventory. And most notably, it's going to take layoffs and the unemployment rate going from something like 3.5% to 7 or 7.5% to really cause the mortgage defaults and foreclosures to surge. Because there's another aspect of government manipulation of the housing market that's led to the current situation, and that was all of the foreclosure bans that occurred during the pandemic. According to the Biden administration, they kept nearly 2 million homes.
That's a big thing to pay attention to.
Owners in their home during the COVID pandemic. They're saying that there was 1.8 million FHA borrowers who received forbearance and thus weren't foreclosed on, and 1 million of those borrowers actually received a plan to lower their monthly mortgage payment after their default, which is crazy. These people defaulted, and in response, the government lowered their monthly payment. So let's just use the number of 1 million instead of 2 million. Say there was one.
What do I say? Like, that feels like something bad's going to happen.
Million foreclosures that were prevented during the pandemic due to these moratoriums. Well, then what's that impact on inventory? Well, right now, according to Realtor.com, there's 563,000 homes on the market. That's more than there were a year ago, but it's still about 50% less than the levels of 1.1 million before the pandemic. So we're 50% lower on inventory, but if we had those foreclosures, if we had 1 million foreclosures, that shot our active listing count on the market above where it was before the pandemic. And so what you gotta understand is that both the US government and the Federal Reserve in concert did everything in their power over the last 3 years and over the last 20 years to juice the US housing market, to deplete inventory, to cause prices to go up, and now they're unwinding those things. But we're not going to see 20 years of artificial suppression of interest rates and the associated investor and speculative behavior. We're not going to see that just get eliminated in a year. And ultimately, my fear is that the Fed is going to end up actually breaking something in their fight to do this. I think at some point they will eventually be forced to pivot. And when they are forced to pivot, it's not going to be this great event.
They're going to break something. They're going to keep doing what they do until they break something, because that's what's going to force them to change their direction, like pivot or stop tightening or even go to QE and print money, right? When we had Silicon Valley Bank collapse, that forced them to inject some money into the market, which was really as loans, I guess, for banks that were having massive deposit outflows that were becoming insolvent. So it forced them, but they still kept their course. But it shows you that, you know, some of the screws are starting to loosen.
event that all of a sudden is stimulative to the market. It's going to be because something really bad happened and the unemployment rate ends up at 8 or 9% and there's big problems. And I just also want to address something. I know a lot of you guys have been watching my channel for a long time. I started my YouTube channel in late 2020 and I made my first housing market crash prediction on YouTube in April 2021, 2 years ago at this point. And a bunch of the predictions I've made in between have come true. Other predictions have not come true, or at least have not come true yet. And I think it can be frustrating for a lot of home buyers out there who have waited to buy a home to still see that the market is tough. It's still really expensive, still doesn't feel like a good time to buy. And I think ultimately the question you guys have got to ask yourself is two things. Number one, how long can you hold out, right? Like how long can you hold out? How important is it for you to secure a price that you feel like you can afford and to not overpay and be house poor? That's question number one. But then number two, more importantly, do you believe in the
house poor? Remember that. Look up what that means. House poor. Something that should be taught to everybody before they ever buy a house.
fundamentals? This is the essential question, because when we look at the fundamentals, when we look at this graph comparing home price growth to interest rates, we know that the longer that interest rates stay up around this level, the more that inflation adjusted prices go down. When we look at this graph comparing home prices to incomes, we know that it's not sustainable to have home prices all the way up here at 92% growth since 1970, while incomes are only growing by 24% since 1970 adjusted for inflation. This gap is not sustainable. It has never been sustainable in US history. Or do you believe that this time is different?
I mean, let's look at that again. Look at that gap. Look at that gap. Look at that. Look at these gaps. This was the housing bust in '08, roughly '06 to really 2006 to 2012. That's what this was. This housing bust. 6 years. Over half a decade. You get that? And now look at, we came down, we got back to previous highs from the, late 80s. That's how this gap is here. And then we took off again, and we tried to keep up income growth, but then right here it just said, goodbye, just like that. And this is actually going down now. Law of averages, reversion to the mean. It is a natural law of the universe.
It has never been sustainable in US history. Or do you believe that this time is different and that the old school rules and the fundamentals that apply to the housing market and economy?
And what we're saying isn't speculation. It's not. It's pure mathematics. It's mathematics. I don't want it to be true. I don't want it to be true. I don't want this shit to happen. But whatever. Who cares what I want? Who cares what you want? What's going to happen is what's going to happen. We have to see what's going to happen. This is going to happen.
Don't apply anymore. A lot of people are saying now that this time is different. They say that due to the low inventory, due to the investors.
Yeah. This time is different. We're going to bring this chart. Where are we at here? 1308, so I remember. We're going to bring this chart. This time's different. We're going to go even effing higher, right? We're going to double that. We're going to go even higher. Only if rents can afford it and investors see the value in buying it, like your BlackRocks and shit like that, because they're trying to own every home in America, right? They don't want you to own anything. Charles Schwab, you will own nothing and be happy. Let me get back to this. You will own nothing and be happy.
Time is different. They say that due to the low inventory, due to the investors buying the housing market, prices will never
hit the subscribe button.
come down. But I'm personally very skeptical of this time is different arguments, because the housing market over 100 plus years has been very consistent. It grows at the...
Look at that.
The income.
Let me rewind that. Look at this. Look at this. Look at that chart. Look at the mean. Look at the average. Until right here, in about 2000, whoop, boom. And then it came back into the upper realms of sanity. And then it went whoop. This has to come down. Either this has to come down or wages have to go up dramatically. And the only way wages are going up dramatically is hyperinflation. What is hyperinflation? Well, that's printing a shitload more money, meaning each dollar is worth a shitload less than it was before, right? In terms of its buying power, right? I remember when I was a kid, I could go to a movie, get popcorn and a pop, and it was $5. Now, popcorn alone is $12. Right? That's what I'm saying is your dollar doesn't go as far. The only way wages go up to match this, to even bring it back to a level of sanity, is if they print a bunch more money. But what do you think the odds of that are? What do you think the odds of that are? You think they're actually going to just print a bunch of money and just give it to the people? Let's give it to the wages, not the corporations, not the investors, not the banks. Let's give it to the people. Woo! Where have you been living? Let's come to reality. This is coming fucking down. I'm sorry if you bought a fucking house in early 2022 at the top of the market. I'm sorry that you don't want that to be true. I hope you bought a home that you want to live in for a very long time. You got a great interest rate. That's a big positive. But the value of that home is going down. It's not going down right now. This is going to take years. You will see what I'm talking about, what Nick's talking about in the next, you will start to see the real reality of it in the next 1 to 2 years. And that probably won't be the end. Just like here, the great financial crisis, the housing market peaked in 2006 and bottomed in 2012. It took 6 years. This won't be that. I don't think this will be that. That's why I'm saying, it's already been a year, almost, because the top of the market was really about Memorial Day weekend last year. We're not there yet. So I'd say we might bottom in the next couple years. I don't think many people don't understand how insane the money printing, the economy, the inflation, the fucking just insanity that has happened for over a decade. And it needs a reckoning moment. Not because I say so. Not because I'm like, you need a reckoning moment. No, because it's a law of the universe. This can't keep going. My phone stopped. Maybe let's just watch this.
100+ years has been very consistent. It grows at the rate of inflation in incomes. And when it goes above that rate, prices have to come down.
Exactly. They got to come down. They got to come down. Listen, thanks for watching this video with me. I hope you got value in it. I'll be making more of these. I like doing videos like this because I watch a lot of videos. YouTube is my main source of content. I like to use it. I like to make stuff on it. And I thought, no one in my life wants to watch this shit with me. How about we watch it together? Sound good? So, and I have a lot of experience in investing and economics and finance. So I can throw some stuff here. Plus, I've been doing YouTube and TikTok and stuff a long time. Hopefully, I'm a bit of a enjoyable personality to hang out with. If not, that's fine. Go find someone else that is. None taken. I wish you well. But that is it. Hit the subscribe button.